Good day, fellow investors. In this video, I'm going to argue that given the current state of interest rates, the outlook for those, I'm going to argue that yes, the S&P 500 could very easily double over the next 6 years to 10,000 points, but nobody would really be happy about it. And also, as we discussed in this video where the impact of 8% interest rates would be disastrous, in the same scenario, I would not be surprised if the S&P 500 first drops 50% and then goes to 10,000. Now, in this video, we had some really good comments how nobody believes that interest rates will go up, that 8% is not sustainable, that everything will be controlled Japan style, that also 8% interest rates would do very good for companies that have high amounts of cash as they would make more profit, and therefore even with higher rates stocks would go up. This is correct, but this is maybe just 10% of the whole pictures. So interest rates do work like gravity on stocks, as Warren Buffett says, and we have to see what is now priced in the market, and that is, as we discussed in that video, an 80% chance of things going to plan, thus 2.5% in a few years. But given the recent news and situation with interest rates, maybe the current interest rate will not follow a downward trend as everyone expects it. And you can already see that this range was expected already to be much lower by now, but that isn't happening. The cuts are postponed, and who knows, maybe we'll even have this in the next few years to 8% or even higher. There was another great comment, so what's worse, keeping rates low and inflation, or keeping rates high and basically going into government default? The government cannot default because it can just print. Nice comment here by Daniele, thank you. That's why we put money in rubies and forget interest rates. An update on that tomorrow. So not even the Fed knows whether interest rates will go like this, or will follow the expected trend down. As you can see, interest rates over time went up and down, and people always bake things into the market, but I have think and see things non-linearly, because then you're not surprised, and even if something happens that surprises you, you know that it can happen. The current market and also the comments, and that's why I also put the comments in this video, were very, very convinced that this time it's different, stocks will only go up. On that I agree, as I'll discuss in a moment, but that conviction is a very, very dangerous place to be, because you're not considering the risks, and as a value investor, we are always here to discuss the risks. Talking about risks, if interest rates go lower as the market expects, then the current Shiller P ratio of 33 is justified, despite the fact that in history there were just 2 times when it was higher, and investment returns from the dot-com bubble and the roaring 20s were not good. And also in the Nifty 50 60s, the P ratio was below 25, and then again we had very, very bad returns. But yes, now 5%, that would justify a P ratio of 15 for a 50% downturn in the S&P 500, but as everyone expects this in the longer run, then it justifies a 33 P ratio, perhaps even a 40 P ratio if interest rates go back to 1 or 2%. However, even other indicators like the Buffett indicator shows that at the current moment, the stock market, comparing the market capitalization to GDP, which is the Buffett indicator, shows how the stock market is strongly overvalued, as it had been during the dot-com bubble and during the Nifty 50s. And since then, the Nifty 50s, the returns have been terrible for 3 decades, as you will see later. But there is something we have to discuss. The S&P 500 can go to 10,000 by 2030 because if there is a market crash, if there is something, some issues, whatever, the Fed will double its balance sheet again, print money to solve issues, which will lead to a spiral of inflation, and real returns would be negative to zero. But yes, the S&P 500 could easily be 10K or more in the next decade. To discuss a little bit deeper what am I talking about here, if we check the long-term chart of the S&P 500, and this is inflation adjusted, the last time the Buffett indicator was that high was the 1960s. And inflation adjusted, this is the S&P 500 at 900 points, and then it took 70s, 80s, and only in the 90s it took for the market to break even from a real return perspective. In the meantime, it went from 900 points down to 355 for a huge decrease adjusted for inflation. If you don't take inflation into account, it looks much better, but still we had this huge drop during 73, 74, real market crash, recession, and also one during 69. But you could make a lot of money on these ups and downs too. However, it still took 15 years of no returns, which is a very ugly thing for markets. And the current risk and reward is where the most likely outlook here is that over the next 10-20 years, real returns might be zero, but if the Fed prints money again, then yes, stocks might double, go to 10K for the S&P 500, but nobody could be happy about it. And interest rates can go higher and also can go lower, and if we have a spiral of inflation at some moment in time, one of the best investments in 1981 was to buy the 30-year US Treasury at 15%. Somebody put $1 million at 15%, and for the next 10, 20, 30 years, they were getting 150K a year from that investment. Or they could have also sold when the 30-year Treasury went to 7.5, they doubled their million. So at any point in time, there will be good investments, there will be ups and downs. So the market could go down 50% in the next 3 years, then go up 4x in the next 6 years. And that's also something that I want to discuss. A lot of time in the comments, everyone expects perfect execution, perfect prediction, perfect everything, but that's not investing. Investing is about being vaguely right in broad ranges and broad trends so that you compound your wealth no matter what happens. If this happens, I want to have the cash flows to buy more here, to take advantage of the opportunities. Thus, I have to now invest in businesses that offer dividends or some hedges or things like that. If there is inflation, however, I also want to be invested, because if I don't invest, I wait, then I lose a lot on potentially long-term inflation. So it's very hard to be precise in the prediction on what to do this, do this, do that. No, I want to be positioned in a way that if there is inflation, I am protected. Tomorrow we'll discuss an investment that protects you from inflation. And I also want that if there is a crash, I can reinvest, increase my wealth, increase my ownership. That's the story of investing. Not trying to be right, but trying to be a little bit better every year, no matter what happens. And that's exactly also what Warren Buffett has been doing since like ever. And you can see that especially after the bad times in the 70s, he simply destroyed the S&P 500 because he always focused on that ownership business, compounding of businesses over time, and the rest is history. Now, people ask me, Sven, what to do? Should I sell? No, it's again a process. We are still in the right moment in time where you can slowly thinking about it, changing, waiting for your thesis now to develop, and then slowly exchange them for value investment thesis that will save you a lot if more troubled times come. Just start slowing 5% of your portfolio rotation over a year, over something like that, over 5 years, you have a very, very robust portfolio no matter what happens. Thanks for watching. I'll see you in the next video.